Bill, this is the final jobs report for President Obama. I would suggest you want to step forward that this is a constructive jobs report for President Trump as well.
Yes, and I think a little schizophrenic, as you just pointed out in the last minute or so. Jobs grow strong, but wages revised down by 0.2%, and instead of 2.7% annual, now 2.5. I suppose that's good for corporate profits to keep wages down, but ultimately we know that it's consumers and consumption that drives the economy, and if they don't earn enough money, or if their money is only growing at 2.5%, then that's a slow growth economy. So sort of schizophrenic report, and I can see how markets might interpret it one way or the other.
I want to bring this right over, Bill, to the bigger picture this morning. Again, futures advanced, Dow futures up 95, not near the 20,000 level, but I like what Bill said there about a schizophrenic tape. Bill, if we get a reflation, from where you sit, is it a reflation that gives us an inflation boost, or can we actually hope that the real economy will boost with the Trump stimulus?
Well, sure, and that's the hope that real GDP, which is now around 2%, and actually for the quarter with the Atlanta Fed above 3%. But the hope is that we're in a 3 to 4% real GDP economy. That was the promise from the Trump administration. That's the hope in terms of fiscal policy and stimulation, deregulation, and so on that we look forward to. I remain skeptical, I guess. I remain, of the camp that the productivity is the key to real GDP growth. We know labor force growth is less than 1%, so it's all productivity. And what produces productivity? Investment. Investment hasn't been there, as you've discussed, for the past 30 minutes, and to the extent that it remains anemic, then productivity will remain anemic. And I think we're stuck in a 2% real GDP world, no matter what the fiscal stimulation and no matter what the deregulation.
One of the exogenous shocks, and folks, we have to remind ourselves that Mr. Gross for decades has had an international perspective where dollar dynamics really are there. A key conversation, Bill, this week was with Barry Eichengreen of the University of California at Berkeley, and Professor Eichengreen was adamant that Mr. Trump will lead us towards dollar strength. Do you show up at every day at Janus just assuming dollar strength?
No, I mean, the dollar's had a good rally, and certainly against some emerging countries like the Mexican peso, a significant one. So I don't assume continuing dollar strength unless, the Fed stays ahead of the ECB or the Fed stays ahead of the BOJ. And, at the moment, that's not the case. Both those central banks are still, stuck on quantitative easing of significant proportions, and that's led to the dollar rally, and that's led to stronger growth in the United States. But, I think there's some catch-up coming into the equation from Japan and from Euroland. Their growth rates are close to 2% as well. And so, dollar growth and dollar appreciation is certainly not assumed. I don't think we have a new Plaza Accord ahead of us in which the dollar, the strong dollar, threatens the global economy, and we have to take some significant measures. I don't see that.
Bill Gross, let me frame what keeps surveillance going, which is two perspectives. We got your caution with a 2% GDP. Peter Hooper, the esteemed economist at Deutsche Bank Securities, would suggest a more optimistic tack. What is missing from the optimists? What are they missing about their belief that we do get good, if not great, economic growth, and by definition, a higher interest rate regime? How will that not happen?
Well, I think they have a point. If you have a strong fiscal program, we don't know what it is, but if it's $1 trillion to $2 trillion over 10 years, that's a plus 0.5% over the next several years. There's no doubt about that. And with corporate taxes being cut, there's the potential for a near-term stimulus. I'm talking about real GDP over a relatively longer period of time, 3 to 5 to 10 years, and I think we're stuck in this 2% zone. But the short-term optimists, I'll grant them 3, perhaps over the next year or two, and that's a positive for equity markets. But and that's a positive as well for higher inflation and a positive for higher bond yields. And I can talk about that in a second.
Well, we'll talk about that. But the inflation, the idea of higher bond yields. But critically here, I know, Bill, in your office at Janus, you've got a Bloomberg terminal. It's a vanity terminal. You barely look at it. You're still wedded to your Monroe Trader. The fact is, you're still back looking at the most basic calculator out there. Does your Monroe trader tell you you can buy bonds right now, whether full faith and credit or foreign or corporate?
Yeah, I think to a certain extent, and the reason is, Tom, is that other central banks are buying bonds. You know, the U.S. went off the habit, so to speak, the QE habit about 2 years ago, but the ECB, the BOJ, the Bank of England are still in there plugging at $150 billion a month. That's a lot of money. That's
right.
Basically $1 to $2 trillion a year going into the bond market, and that provides tremendous support. For instance, in terms of arbitrage, you can move into Treasuries at 245, from Bunds at 45 basis points and pick up 200. Currency adjusted, you can even pick up, 50 to 60 basis points from Bunds to Treasuries. Same thing with JGBs at basically 10 to 15 basis points. Huge arbitrage there, even currency adjusted. So to the extent that you got 150 billion coming in a month from these central banks,
right.
Basically it means that central banks are still supporting a low interest rate environment. I don't like that,
right.
But you have to recognize it as an investor.
And this is very important, folks. What you just heard from Mr. Gross there is a classic long short of what you do nation to nation given divergence. Are you picking up dimes in front of a bulldozer? Are you going to get run over by the Trump administration doing your cute arbitrage?
Well, I think you have to be careful, and that's why at Janus Unconstrained we've got a zero duration, but we've got the arbitrage between Bunds and Treasuries. I'm of the persuasion, and I think I talked about this last month, that U.S. Treasuries at 2.6 or 2.65 is a critical area, and that's a technical type of interpretation, but it's a long-term trend line, Tom, going down from
right.
1984, and it's been hit on the upside by 7, 8, 9 times. 2.6 is very critical. And if we get higher inflation and higher yields relative to 2.6, then we've got a bear market.